make sure we respect everyone's time. Good morning, everyone. Thank you so much for being here with us this morning. I hope that you all are staying dry and safe. I'm going to let Mark tell you where he's presenting from here shortly, but here in Louisville, it is storming on and off. There's lightning and all the things. So I hope that everyone is somewhere safe and dry. I'm Kiana Baker, Director of Community Engagement at Amplify Louisville, and I am so excited to be bringing you all this presentation this morning, this workshop with Mark Kramer, who is a wealth of knowledge in this area. And as we all know, all things post-COVID, doing things virtually is kind of like what we've become normalized to do. So making sure that you know how to pitch yourself properly is so important. So I'm very excited myself to even get to gain the wealth of knowledge that Mark is going to bring to us this morning. So I'm going to let Mark introduce himself and get along with the presentation. If you see in the chat, and it's lightning really interestingly out my way, but please put your questions in the chat, and at the end, Mark is going to answer those questions. Mark, if you need me, I am here, but I will let you take it away.
No worries. So good morning to everyone, and I am talking to you from Hanoi, Vietnam. So like Robin Williams said in the movie, good morning, Vietnam. So good morning from Vietnam. So good to see all of you. As you know, I started the SMS Enterprise Center in Louisville, and I love the city. I think it is one of the most overlooked entrepreneurial communities in the country. And I'm just glad to be able to share information with you about how to raise capital. Just as a background, and I will kick this off here. We're going to be talking today about how to raise money virtually from investors from around the world, because, you know, let's face it, no matter where you are, unless you're in Silicon Valley or New York City, you really have to go and present your ideas across the world, because you don't know who might be interested and who might be a good fit for you. So my background in this is I'm the executive director of the Private Investors Forum in Philadelphia, and I teach entrepreneurship at Vinh University in Hanoi, Vietnam, and I'm here for the next year. I started the world's first formally organized investor angel network in 1990. And back then, people thought it was crazy that rich people would ever want to meet entrepreneurs they didn't know and invest in them. And I had started Penn State's Technology Development Center, and I was trying to help companies raise capital. And if I couldn't get in front of seed stage venture funds that everybody knew in the city, there was no way to help these companies. And most of the venture funds didn't want to put money into very early stage companies. So I started the very first one, the Pennsylvania Private Investors Group, in 1990. And from that, now we have them around the world. I ended up luckily being on the cover of Profit magazine and featured in Inc. And I'm just glad to see that now people all over the globe are able to access wealthy people. I myself am a serial entrepreneur. I've run 25 startups. I've served on the boards of 10 companies besides my own. I've raised over $3 billion for my own ventures. And I've worked with over 2,000 companies, helping them with their business plans, investor presentations. I've written 6 books, and I wrote a national column for American City Business Journals. So let's get started. The Angel Venture Fair, which I run, has a virtual fair, and people always asking me, you know, how do you get involved with that? And it's $400, and we provide written feedback on investor presentations. We conduct video interviews. We do a live video presentation to investors around the world. and we email link to investors presentations to investor groups in the Angel Capital Association, which there are about over 200 of them. And we email to over 5,000 seed stage venture funds and family offices and corporate VCs from around the world. So where do you find investors? I mean, that's what we're always being asked here is how do you go and connect with them? Well, there's a lot of different groups that can make introductions. Accountants, because they represent a lot of wealthy people. They also now represent angel groups themselves. Bankers are a great source of making introductions because not only do they provide the least expensive form of capital, which is actually not having to sell your stock, but they also interact a lot with VCs and angel investors. Chamber of Commerce, college alumni. Now, a lot of college alumni have their own venture funds. Almost all the Ivy League schools have venture funds. Penn State, Michigan, and others are starting angel groups and venture funds related to investing in alumni. Investment bankers themselves are wealthy, and they also represent wealthy clients. There are a lot of lawyers, accountants, and bankers themselves that are angel investors and belong to angel groups. In the Philadelphia area, we have 5 angel groups, and all of them have lawyers, accountants, and insurance brokers, all who are angel investors. You can meet them at meetup groups, investor angel networks, and venture capitalists who might not want to invest in such an early stage company usually know angel investors because they've also been investors in their funds themselves. So what's the 10 steps to raising capital? First, you have to develop a financial model, an investor presentation, a business plan. The most important part of this is actually the financial model, because if you have a really solid financial model and they can see the detail and how you arrived at your numbers, then they're going to trust the information that you give them. And to raise money, you really have to be thinking about growing a business of 50 million or greater within 5 years. And whatever number you show investors, and we'll talk about this more during this presentation, they're going to cut that number in half. Seasoned angel investors and VCs will cut your revenue projection in half and double your expenses. And frankly, from doing over 25 startups, it's pretty much always accurate that there are things you never accounted for that happen. So it's pretty rare that you hit those numbers, but if you can show solid numbers and defend them, and angel investors and VCs and corporate VCs and family offices, they'll all take a look at that. They'll take you seriously, and you'll have a good shot if in fact it's a good fit for them. Then you have to obtain introductions to investors and go through all those people and sources that I just mentioned. Then write to investors after meeting them. So you might meet them at different events, and then you need to follow up with emails to them. Then send executive summaries or full plans to investors. Many people say to you, you don't need a business plan. All you need is an investor deck. I'm still raising money for a venture in the metaverse, and I have another venture as well that I'm working on. I've never come across a time where investors just put money in based on a investor PowerPoint presentation. Every single one of them has been asking for, oh, so can I see your full business plan so I can read your marketing strategy, your sales strategy, what you see as the competitive differentiators. I want to see your financial model. I want to see all the detail, because your funding presentation basically gives them enough information that they want to have a conversation with you and then take it to the next level. So then you make a presentation to investors, you negotiate with the investors. The investor says, yeah, I'm interested in investing. They give you an offer, and now they're going to start doing due diligence to determine if they want to follow through with that offer. Then the lawyers review the documents. And when I have lawyers do my documents, I don't have them negotiate for me. I do my own negotiation, and I just ask the lawyer, what do I need to go and push back on? Where can I be taken advantage of? what would not be in my best interest, which is unfair, that I can push back on, that the investor will understand and will be agreeable. Then both sides discuss changes in the agreement and the agreement's made. Typically, it takes 6 months and as long as 2 years to raise capital. I had an insurance venture. I created the first insurance product to insure small business bank accounts against cyber theft. And from the first meeting with the insurance company to the actual close, it was about 2 years of discussions. And frankly, I was talking to 5 insurance companies, and they were the only ones that could invest in this deal because I needed about $50 million in reserve for each of the 3 states that we're entering. So there's not many angel investors, even VCs, that can just put $150 million aside or have expertise in a certain area. I raised $3.2 billion for a company called Prompt Payment that I created the concept of reverse factoring. And again, it was, well, I knew the people who were the lead investors, and it took about 9 months for them to help us raise the capital that we needed to get this off the ground. And then finally an agreement is made. So it takes, as I said, anywhere usually from 6 months to 2 years until you can actually close that money. So what do investors look for? Investors look for a big growing market. If you watch Shark Tank, and I'm sure all of you do, what are they always telling the entrepreneurs? They're looking for a fast moving train that can't raise enough money from banks and other investors, but they can put the money in and they could really set this thing on fire. Every investment that they make, the companies aren't losing money. They aren't treading water. They're growing fast and they're in big markets. There are few competitors. I have to say that you're always needing competitors, because if you don't have any competitors, you spend all of your money educating the market, which has happened to me numerous times. I one time was asked by the insurance company invested in me, the chairman, and the chairman said, "What's your biggest concern?" I said, "Lack of competition." And the board of directors of this New York Stock Exchange insurance company were in the room. And he turns to the president of the division that was overseeing my investment. He goes, "Did we invest in a moron? Why would you ever want competition?" And I said to him, "Because I'm going to be spending over $1 million just educating the market to know, letting them know that they need our product. And I'm going to run out of money and you're not going to want to put more money in," which is exactly what happened. And now that product is offered everywhere by insurance companies. They're interested in proprietary technology, something that differentiates you, something that if everything goes wrong, that you can sell it. I had a friend of mine that he had raised a few $1 million for his venture. The company was treading water, but it had great patents. And he was able to sell that company for $25 million and got a great return for his investors because he had patents and proprietary technology. A strategic investor, which is always the best kind of investor, invested in his company, and so bought his company out. And so that worked out really well for them. They're looking for domain expertise. You can come up with an idea that's out of your wheelhouse that you weren't an expert on. Most of my deals I was not an expert on, but I made sure I brought in partners who helped me run the company who were experts, domain experts in the area. They want to see experienced management and investments that can leverage their expertise. Today's angels are infinitely smarter than they are when I started in 1990. Back in 1990, they were buying lottery tickets, and they're still buying lottery tickets, but they didn't really care so much about whether they could help the company or not. But now angel investors are very seasoned, and they realize that the best chance of getting a good return on their money is if they could open doors and help the company sell, if they can help recruit good employees. So They want to invest in things where they can leverage their expertise and contacts. So a formula for a winning presentation: you have to identify a problem that somebody actually wants to pay to solve, not just a problem that you think needs solving, but a problem that they would want to write a check for to get solved. There are plenty of ventures that have started that are opportunities, but the best ones are ones that you're solving a problem that somebody's willing to write a check for. But there've been plenty of success stories. I mean, plenty of restaurant chains. We remember, if we're old enough, the Pet Rock was a great, had a great return. So those are, people see opportunities. Movies, there's nobody saying that they absolutely have to have this movie. And if you invest in a movie, somebody sees an opportunity because they think it will fit a certain genre and it will do well. Concisely explain your solution in a couple sentences. I say, if my mom can't explain it to her Mahjong group, then I'm not doing a good job. And so it has to be easily explained. Easily identifiable competitive advantages, not just that we have better customer service, not that we have more experience, but something that really tells that you're different, that the code that you have, that the drug that you're making, that the website you have. In Louisville, there's a terrific company that is marketing tour guides, and they really have a really good setup, and they're partnering with another Louisville company that sells handmade fishing tackle. So you can see the competitive differentiators there, with a handmade fishing tackle and somebody who is actually identifying and interviewing and marketing seasoned tour guides. That's really a strong offering. Strong marketing and sales tactics, strong sales strategy and process, a great understanding of the competition. You're always going to be asked by investors, so who are your competitors? And if you go, I don't have any, everybody has competitors. The car had competitors. The competitor to the car was the horse and buggy. Everybody has competitors, so you have to know them. And people want to know, do you have one revenue stream? If that doesn't work, what happens? Multiple revenue streams are really important. I once worked for the chairman of a company called Senecor, and they had 5 drugs in their pipeline, and their main competition only had the one drug, and they had the same drug, and the 2 of them didn't get approved by the FDA for their Septis drug. And the one company called Zoma, they went out of business, and Senecor ended up being bought for $4.2 billion by Johnson & Johnson. So having multiple revenue streams is really important. And as I mentioned, you'll hear me say it over and over again, well thought out financials with lots of detail on how you arrived at your numbers. So 7 important parts to an easy to understand presentation. This is really important. Easy to read graphics. I can't tell you how many times, and I have a separate business where I review people's PowerPoint presentations, and the graphics are too hard to read. The spelling out and minimizing use of acronyms. People get crazy on the acronyms, and then you end up looking them up and you could end up with the wrong acronym. So spelling things out, making sure the video is embedded in the presentation so you don't have to connect to it. Things always go wrong, and that's one of the things that consistently goes wrong. You're doing a presentation, they tell you have Wi-Fi, you can hook up, you test it beforehand, it seems to work, and then comes the presentation and it doesn't work. So I always embed my video inside of the PowerPoint. Easy to read font size, because while you're speaking, people are reading it. You'll notice that the font size on my presentation is very easy to read. No more than 2, but preferably 1 slide describing the product or service, not multiple slides describing this, because then you lose people's attention. It's hard to follow. And again, if I can't get my mom to easily explain the Mahjong game, then I haven't done a good job of writing it out and explaining it. Minimize technical descriptions that a non-expert could understand and explain. People who do technical ventures love the technical part and they think everybody else does too. But not everybody is into it. They just need the simple explanation that they would understand, being not the experts. And no more than 20 slides. I've had people show me 60 slides. Guess what? You've got about 10 minutes to make your case. And after 10 minutes, you're going to lose them. So people have short attention spans. So 20 slides or less is all you need to cover everything. 15 parts of an investor presentation. This is exact order that I tell people that they should always use, because this is the easiest way to tell the story. You're always starting out with what's the problem or opportunity, and you're briefly telling them why you thought this was a problem and opportunity, something that you experienced or saw that told you this, and then you investigated and found out that there really was a problem here, and that you can back this up with third-party statistics to show them that there is a problem. Then you want to talk about the solution. Then market opportunity, trends in the market, how big is the market? I was doing one with my students. I founded a company called Funding Organizer. It's a common app to apply for commercial bank loans. And I had my students do it as part of their test, said, what's the market opportunity? And only a few of them got it right. The target for this company was to provide a easy online solution for commercial loan officers to send to their prospects to fill out online. So instead of taking 4 to 8 weeks to apply for a commercial loan, it could be done in an hour, a couple hours at most. So I told them, you have to be able to tell me in the marketing opportunity, how many banks, savings and loans, credit unions are there, and where did you get that number from? And are they still growing or shrinking? Is the number of commercial loans growing or shrinking? So we need to understand that. Product service description, intellectual property. Do you have any IP whatsoever? And I really don't consider having the name as a piece of IP, which is good to have, but I don't think that's really a selling point with people, or the trademark. What's the target market that you're going after? And when we say target market, not only the industries that you're going after, but who in those companies are you going after? Same with your marketing strategy. What's the strategy you're using to get it? And what tactics will you use? Same with sales strategy and all the different revenue streams, competition, then talking to people about client retention. Client retention is an incredibly important thing for people to know. I can't tell you how many times I taught at the Wharton School, MBAs and executive MBAs, and I was teaching them about business plans, and we would do consulting for foreign companies who wanted to enter or expand into the US. And not a single one of these guys who typically came from private equity ever put down client retention. At the end of the day, you don't want to have to be constantly chasing people to go and start from scratch every year. There's no way to build a sustainable business. So you have to think about client retention. And on your management team, then people want to see a 5-year financial forecast. How big can this be? They want to dream big. What's your capital needs? How much money you're looking for? We'll talk all about this throughout. So as I mentioned, the problem is a 1-paragraph description using a third-party statistic. And here I give you an example. And by the way, this PowerPoint, all of you will get a copy of it. So not only will you get a copy of the video to watch this later, but you also will get a copy of this PowerPoint, and you'll see the examples on here. So what's the solution? 1 paragraph describing the solution. Make it short and to the point and tell people where it's located, but it's got to be easily understood. Your market research, description of the market, the size of the market regionally, nationally, internationally, with all third-party statistics. I can't emphasize enough that you're like a lawyer in front of a jury. So you've got to make a case to these investors about why they should part with their money and buy your lottery ticket over someone else's. Projections of market growth with third-party stats, market trends for each target audience that you would use the product and service with third-party stats. Remember, there's multiple parties that you're actually marketing to, and we'll talk about that in the marketing strategy. So your marketing strategy and tactics, your description, your target audience, and your strategy to make them aware that you exist, followed by the tactics you plan to use to go and build this. So no matter what you're selling, you actually have multiple markets. One is the check rater, one is the actual user of your product, and one is the influencer who's suggesting that somebody use your product. And really, there's even a fourth one, which is the media, because you're trying to gain visibility. So in my company, one of my company's funding organizer, we're targeting presidents, chief lending officers of community banks, credit unions, and saving loans with $1 billion in assets or less that can't afford expensive loan packaging software such as nCino. So to see how I succinctly explained who my target market is. And then I mentioned, we'll be sponsoring events through their trade associations, running online seminars, and advertising in association magazines. Then your sales strategy. The question is, will you use an in-house or outsource your sales? And maybe you don't need a sales force because obviously if you're starting a pizzeria, you're not using a sales force. If you have a dry cleaning business, you're not using a sales force. If you're selling on Amazon or eBay, you're not using a sales force to go and sell people unless you're going to go sell directly to corporations, and then maybe you'll have somebody calling on them. But any of those kinds of things, you're probably not having an in-house or an outside sales force. You're relying more on marketing. But if you do have to get in front of people because you're selling electronics, you're selling some type of IT service, cybersecurity, whatever that might be, you need to have a sales force. And whether you're outsourcing, like often young drug companies do, they outsource it to sales forces that sell multiple drugs. That will make some sense. Will you rely on marketing and not have an actual salespeople? And how many different groups of salespeople will you need? Example, selling to a customer, to a distributor, and to an end user. You might have 3 different groups that you're having sell within your own organization. Revenue streams, number of revenue streams, the primary and actual product like software, cars, or drugs. You have a primary revenue stream, then a secondary revenue stream. Then you're telling people that here's the future streams that we can go and develop. And you're listing each revenue stream and what you're planning on charging for that product or service. Here's a sample of a competitive analysis. I always encourage my students and the entrepreneurs I work with to do a spreadsheet analysis with categories on the left, the competitors at the top, and showing people how you might compare. This one was a company I did called Minority Funding. I put them at the end, or you could put them at the beginning, or you can highlight the row that they're in, but you need to show real comparisons to your competitors and having strong categories so people can see exactly how you match up to the competition. Then the client retention, as I said, this is so important about what you're going to do. So I want to hear a strategy for the check writers, the influencers, tactics for the audience, using advisory boards for users, research reports for check writers and influencers, surveys for users. So I want to understand what the user is going through, and I want to make sure I stay in touch with them and let them know that they're important, and so we can keep having them come back and buy from us. Management team, I like to have pictures because people identify with pictures, and seeing people that make a connection. The titles, responsibilities, and experience. And I always like to mention what college they went to, because somebody in the audience could have gone to the same college, and that could start a conversation. Operations, where are you located? What type of facility, equipment needed, ability to run remotely? Most companies today want to run as much remotely as they can. And of course, there's the good and the bad. The good about running remotely is you can keep your costs down. The bad about running remotely, which is hard for startups, is building a corporate culture, unless you really don't need one because everybody is working kind of individually and doesn't require that. But most startups, you want to build a corporate culture so people feel they're part of something bigger than themselves. So it's important to know what your operation is going to look like and what that's going to cost to do it. Then your financial projections, the 5-year financial projections with top line revenue, bottom line expenses, profit loss, and net margins. And then they want to see capital needs and uses, amount of cash needed to minimally break even, preferably profitable. I'm 62 now, but when I was in my 20s and 30s, investors would be willing to wait 4 or 5 years until you broke even or became profitable. Now they want to see break even, usually outside of the healthcare space, so biotech, medical device. This doesn't hold true, but for most everything else, people would like to see a plan that shows you're breaking even after 1 year and profitable after 2 years. We know that's really hard, and the investor knows that it's really hard, but they're hoping that you're going to have a solid plan that's not going to chew up a lot of money, that you're not going to have a down round where you're selling stock for a lesser price than you sold it to them. And they're hoping that they're not going to get diluted, or if they get diluted, it's because you're raising more money because you're growing faster, and their actual value of their stock, although they own less of the company, the value has gone up. Then the amount of equity that's for sale that you're selling, the uses of the capital. They want to know exactly how you're going to spend your money. And note, you can't use capital to pay yourself back. I can't tell you how many times I've had entrepreneurs put their own money into a company, want to raise money, and want their own money back. So the investor's like looking at them like, what do you mean you want your own money back? You mean you want me to risk my money, but you want your money back? So that is really hard when you put money in. It doesn't necessarily mean you had to make the investment in the beginning. Oftentimes you come to the party with the idea and get it started, and it's the investor's job to put the money in. But different people have different philosophies. The East Coast philosophy is usually, hey, I want to see money in your venture because I want to know that you're taking risk as well. The West Coast doesn't worry so much about that. They're more worried about and focused on, how big is this opportunity? Are these people smart? Is this something that we can make a lot of money off of? So your exit strategy, best option, names of strategic buyers. Always strategic buyers will always pay more than anybody else because they feel the fit is there and they're competing against other people. And by the way, you always want to have competition for the exit. Even though you're not worried about the exit when you're first getting off, investors still want to know, how am I going to get my money out? Would anybody even buy this business? You will hear occasionally investors saying, I don't want you focused on exit strategy, just focus on building a great company. And I think that's great. And that's the way it should be. But there's going to be a lot of investors that want to know, if I put my money in, who's going to go and buy it and how soon can I get out? Second option is private equity. They've got tons of cash. They're always looking to add to their portfolio. Third option, most unlikely option, even in the best of times, is going public. Formula for a successful presentation. I always tell my companies, because I do this, ask the investors why they agreed to meet, because that way you can customize your presentation to their interest. And also when they tell you why they agreed to meet, now they're telling you not only what they like about, but they're getting themselves excited about why they even decided to listen to this presentation. So that's always good. Now, has it ever happened to me where the investor said, I agreed to meet with you because a friend of mine asked me to meet with you? Absolutely. But still, that's very helpful to know that information. So I always like to start out with, why did you agree to meet? Answer questions concisely. Do not ramble. Just answer what they asked you. And if you don't know something, don't try to BS them. Just say to them, I'll make a note and I will get your email and phone number and I will get back to you. Don't volunteer unnecessary information. It's like a deposition. Just answer the question. Don't mention all the landmines. I once did work for GlaxoSmithKline's venture fund, and they were really excited about a company that they invested in. They want to raise more money. And the guy in his plan made it like a private placement memorandum, and it wasn't. You don't go to a bar to meet people and you meet somebody you think is cool and that you're hoping that it might go further, it might develop a relationship. You don't tell them all of the negative things about yourself. You get them excited to the point that when they look at it, yeah, that's something I can live with, but you don't start off by telling them where all the landmines are. Don't inflate your financials. I tell people, oh, you need to be 50 million or greater for an investor to be interested. Oh, okay. And then they up their PowerPoint presentations. Their spreadsheets. And I say to them, now, can you defend that number you just inflated? Because if you can't, don't bother. And if you tell me that you can be a $25 million company in 5 years, I think investors will still listen to that. Never lie. Lying is bad in all circumstances because you have to spend a lot of time making up stuff to cover for that lie. You don't know something, tell them. If things aren't going well, tell them. We learned from Theranos, the woman who ran that company, that frankly, if she had just been honest with the investor, she would have raised more money. If she had pivoted, she would have been fine. If she had closed it down, started another one, she would have been fine. Don't lie about anything. Know your numbers. I once had a client, we went into a venture fund in New York. They loved this business idea. The guy was selling religious products through a catalog and he was killing it. And so I created his financial projections because he said that wasn't something he was good at. And I said, listen, we really need to go over these projections. You really need to know them and not have me have to explain them. So he goes, Mark, I've got it. It's no problem. And so we went into this very successful venture fund. I saw the corned beef and pastrami sandwiches and potato knishes sitting off to the side. The partners were all in the room. The presentation was going well. And then the managing partner said, so explain to us your projections. And my client turned to me and said, Mark, will you walk them through the projections? The managing partner cut me off and said, you're actually asking the consultant to explain your projections and you expect us to invest $3 million in your business? This meeting is over. And he threw us out. And I was pretty disappointed because I really wanted that corned beef sandwich and that potato knish. And then I got a call from him later saying he didn't want to throw me out, but that guy needed a cold bucket of water thrown in his face because who's going to invest money in an entrepreneur who doesn't know his own numbers? Only bring essential members of the team. I one time had a client that was pitching to the Draper funds, and they would say that only the Pope had a longer line to get to than the Draper funds and harder to get in to see. And so this client, who had been a successful CEO, brought a CFO that had just come on board that really didn't know the numbers. And I said, I think it's a bad idea for this guy to be in the meeting. He goes, oh my God, this guy's been CFO of 2 public companies. He'll never have a problem. Well, that guy went down in flames. He could not explain the numbers. And we got booted out of that meeting. They said 20 minutes into it, thank you for coming. It was a pleasure to meet you. Best of luck to you. When the only time they ever invite people in is when they want to write the check and just close the deal. Don't let members speak about their areas. If you're bringing your vice president of sales and your head of marketing, it shows depth, but you don't have to bring them. The CEO is usually good enough. But if you are, let everybody speak about their areas of expertise. Don't bring new members who aren't up to speed, and make sure you have a clear exit strategy. So ranges of investments, you can see from 5,000 to 3 million for angel investors. Yeah, some people will invest as little as 5,000. That's usually friends and family who will do that. And also in foreign countries where the costs are much less, 5,000 can be the same as 50,000. So I'm here in Vietnam, and companies ask for a lot less money because the cost is less. I'm paying to be in a very nice one-bedroom apartment, $310 a month. I pay $128 a year for internet. I can have a dinner for two for $15 here. So if things are a lot less money, it costs a lot less money to support the company. 1 million, 100 million for institutional and corporate VCs. Sometimes you see greater numbers. 10 million to 1 billion for private equity when they're going to invest. And private equity needs to put a lot of money to work. So they like larger size numbers of investments. Best written ways to stay in front of investors outside of driving, getting on the train, or flying to them. Market research, providing data and analysis about target markets that can be useful for demonstrating the size and potential of the opportunity. This can include information on market trends, customer needs, competitive landscape, milestones and traction. They always like to hear, are you making progress? Oh, our sales are doubling every single month. Oh, we just had this great strategic partner. Oh, we just bought in this amazing head of sales. Anything that shows people that you're making significant progress, great to share with anybody. Customer testimonials, providing written and even better video testimonials with satisfied customers makes people feel like maybe I'm missing out on something. Maybe I need to get involved here. Best video ways to stay in front of investors outside of the driving realm. Do video media interviews and get a copy of them and send them out to investors. Do podcast interviews. There are lots of services that will match you up with podcasts that are looking to interview people. That's another good way to stay in front of people. Video conference of speeches and video of online seminars. If you can go and do an online seminar, then send that to people. If you do an online investment presentation, share that with people. So any video brings you to life, and that's very positive and strong. So now we're going to go to questions here, and I am glad to read your questions and answer every single one of them. And it's a 11:15 and out in Vietnam. And I am glad to stay up as late as you like to answer every question. So feel free to ask me questions. So let's see what we have here. Mark, this is great stuff, and I wish you weren't stuck in Vietnam. I'd love to introduce you to some of my colleagues. You must be on LinkedIn, so please send me an invite or accept mine. Thanks. If not, my email, and I'm assuming Kiana will send me this contact information, and she'll send all of you my LinkedIn connection. And if I can, I will try to put that on to you guys while we're talking here. So I'm glad to go and do that as well. But I'm easily reachable, and I'm still working with companies in the US, so it's not a problem for me to connect with any of you.
Absolutely.
So let's see.
Will be in the follow-up email for sure, with the links to this presentation, LinkedIn, all the ways to connect with you. But like Mark said, if anyone has a question, feel free to come off of mute and ask.
Or just, it's better if you write them, because that way I can read them.
Okay.
Okay. Would an AI pitch for investors move slightly faster due to the speed of the development? Not really. I mean, you think because AI is so hot right now, but you have to find the right investors, and still investors don't take the time. They want to get to know you. They've got to study the market. In fact, I think AI being so new makes it that much harder, because they're themselves don't know a lot about. They're afraid of taking risk. You would think logically that because AI is so hot, they'd all want to jump in like they did to cryptocurrency and all the other past industries that people jumped in quickly, electric cars, you name it, whatever people cut into. But usually it's really experts who jump into those things pretty quickly. Everybody else takes time to understand it. You mentioned profitability in 1 to 2 years for non-tech, non-medical. What have you seen as ideal for startups in the med tech and biotech space? Typically, when you're talking about med tech and biotech space, and I can speak from this on a national basis, there are venture capital funds and there are private investor groups and there are corporate venture funds, like most all the major pharmaceutical companies have them. They typically will take anywhere from 6 months to a year to go make an investment, usually faster than that, because they understand those spaces. So you're looking for somebody who really understands that particular space. So it can happen just as quickly, but you're talking to experts here and they're not expecting profitability. Probably could be anywhere. I've seen medical devices that are ready to go and almost got ready and they're just about ready to be approved. And I've seen other medical related ones. We had a company that I forget what the product was, but within 2 years, they were at 50 million in revenue. And by year 3, they were sold for $360 million. So it was a great home run for them. And biotech, everybody knows that, you're like 10 years out for that because of all the FDA approval process. What's the best advice to raise funds for solo entrepreneurs? It's the same advice that I've been talking about today. And that is that you are, it's nice to have a partner. I've had partners in ventures. One, the partner was great. The other one, not so great. And most ventures, I would say, well, not most ventures, I'd say at least half of the ventures are solo entrepreneurs. I've been a solo entrepreneur many times. And so if you are putting together a good management team, so it might be that you are the owner of the company and now you've brought on a president because maybe you're a great chief technology officer or you've brought in good heads of sales, good marketing. What they're really looking for is, do you have a great team that can execute quickly? Having a solid, experienced team is really important. I remember when people used to think, let's just get the cheapest employees, kids right out of college. Well, kids out of college doing computer programming or writing code for games is fine. But if you're talking about sales and marketing, you need experienced people. If you're looking for a CFO, you need somebody who can talk to investors, somebody who can talk to all your vendors and get them to be agreeable on better terms. So you're looking for an experienced team. I want to explain the detail of my financial projection, but I don't want to put too many things in the IR deck. How do I do it? So in your investor deck, you're just giving them the top information. What you're hoping is that when they see this, they're so excited that they say, I want to have a second meeting with you. In the angel venture fair that I run, 93% of the companies in my 16 years of running it have gotten a second meeting, which is the chance to go and explain it. And 10% of them have raised capital, which is huge, which is a pretty successful number. So all you're trying to do in your investor presentation is show them numbers that whet their appetite so they'll want to have that conversation with you. Where can we get a business plan template for funding less than $1 million? They're all essentially the same. And I can probably maybe send a sample plan, but if you follow the outline they gave you and you just write toward that outline, you'll be just fine for that. Where can we, should I always have financials included when sharing the deck? Excuse me 1 second. Should I always have financials included when sharing the deck for intro, or that is more than one-to-one discussion, either online or in person? Again, show them the top line numbers, get them interested, and then you can go on Zoom or something and walk them through the numbers. The more detail you have, the more they're going to believe in your numbers. I raised money for 2 ventures solely on the spreadsheets. When they saw the detail of the number, nobody could question it because I go and say, let's say I'm selling with Funding Organizer and I'm targeting commercial banks, savings loan, credit unions. So I'll give a number, the total number according to banking associations or the Federal Reserve of the total number for each of those markets. And then I'll have a second number there that will say, here are the number of email addresses I can get for each market. So that's all accounts. So if I started off with 5,000 banks, but I could go and get emails for 2,500, then that's my market. And then I create this funnel that says, okay, I sent 10 emails a day, 5 days a week. And here's the percentage of banks that responded to me that they were interested. Here's the percent that were interested in talking online. Here's the percent interested in a second meeting. Here's the percentage that was interested in actually licensing our technology. And here's the number we closed. So I show this funnel and I show, how we've done emails, phone calls, in-person meetings, all these things to get at our number. So they know that I'm not just saying, oh, there are 2,500 savings and loans, and we're going to get 10% of them in the first year, and they're going to buy. People want to see exactly, because most angel investors have been operators themselves. So they know the process it takes to go and get the money. Any recommendations for alternative ways than revenue to demonstrate traction to investors, as my startup requires investment for the product to be manufactured at scale? They want to see who would be willing to take orders from you to go and buy it. So you might be able to have Walmart say, look, we love the product you showed us. We would even be willing to sign a purchase order for this if you can go and manufacture it at scale. And get us to this price point. And I did that for one of my ventures. I got letters from different clients saying that if you build it, then we're more than willing to take a look at it and be one of your clients. Some investors prefer to see a teaser before meeting you. What's your advice for teasers? Video? How long should a video be? Written? What should be included and how long? I like writing myself to start with. So I like to write a paragraph that says, here's the problem we're solving. Here's our solution to it. And here's how we plan to go and sell it. Just kind of like a mini version of the investor presentation, but I only do it like in 2-3 paragraphs. And then I go, if after hearing this, you would like to learn more, then I'd be glad to do an in-person presentation, or because of the distance factor, do a Zoom presentation, and I will do it at the time that works for you, 24/7, 365. Just tell me what works best for you. Will the Angel Venture Fair have an event this year? The last one listed 2022. We have it every year. Even during COVID, we still had it. So we have the virtual one, and every company that signs up for the virtual one gets to present, and we market them all out. For the live fair, we only have 34 spots. That's it. So everybody who applies for the virtual one, they're all considered for the live one. And then the live one, you pay $850 to have a booth. And this year, instead of having presentation rooms, we've seen that it's better to have them all present to all the investors in one big room and actually shorten the presentations from 10 minutes to 5 minutes, because we found from investors that actually the most successful presentation for them is the 1-minute presentation. I'm always amazed when we survey investors. That 1-minute presentation where they told us the problem solution and did all in a minute? That's what drove us to their booth. So we know that having shorter presentations is much more powerful to investors. How will investors view a 1 to 2 person team, CEO, COO, with several contractors and subject matter expert consultants for building an MVP versus a larger team of early members? I think it all depends on the type of business that you're that you're doing. But if you have two founders and there's a CEO and COO and you're using contractors, because that's the smart move to keep your cash flow minimal and stretching it out, I don't think they have a problem with that. If you're bringing in subject matter experts, it's not going to be a problem. When you finally need people and you want to bring them on full time, I think investors feel that's smart not to bring people on before you can afford them. And no matter what you hear investors say, and all of us remember this from the dot-com era, from cryptocurrency, from all these, oh, when the market's frothy, just get as much land as you can. Don't worry, we'll put money in. Don't believe it. Get to profitability as soon as you possibly can. That's where you have your greatest leverage. If you aren't profitable and you need money, now the investor has all the leverage. So don't ever believe anybody. Run tight, run smart, try to not spend money that's unnecessary. You do all that, you have a greater chance of being successful. You have a greater chance of raising money. And again, I can't say it enough. You want to be in the driver's seat. You do not want to have terms dictated to you by investors because you're almost ready to go out of business. I ended up becoming CEO of a magazine company because that's exactly what happened to the founders. I was on the board. I felt for these people. I told them not to go and launch this unless they got the full amount of money. They didn't. And the board ended up firing them and turned to me and said, guess what? You're the only one on the board that has magazine experience. You're the new CEO. I'm like, what? And I was for 6 months, got to profitability. And then we brought in another CEO. Can we make contact AVF before? Yes, but we don't make introductions to angel investors until the people apply online and be part of the program. We just don't do it. I mean, years ago, the board had decided that, we exist to help market you out. We're not making individual introductions prior to, and frankly, we have no idea who's going to invest in you. That's why you're up in front of 300-400 investors in a live event. And we market this out to, I guess, almost 10,000 investors and conduits in our virtual event. Again, now because of COVID and people got to 2 years used to using Zoom, they're more than willing to invest in that. Okay, so is there any other questions before we call it a day where you're at, a night where I'm at? And again, I'm glad to answer as many questions as you can throw at me.
This has been, while we're waiting to see, this has been wonderful, Mark. You are just a wealth of knowledge, and to everyone attending, we will make sure that you get all of the follow-up information and how to connect with Mark in the future.
Here's a question.
Yeah.
Is it true that angels interested in only ventures that make their capital 10 times more in less than 5 years, or that is not true always? Well, I'm thinking about it. You're buying a lottery ticket. You don't walk into the 7-Eleven and say, you know what? I'm buying this lottery ticket. I really don't want to win that much money. Now you're hoping to maximize your investment. So they're usually looking for 10 to 20 times the rate of return. And why? Because you're going to hit a lot of dry holes when you're drilling for oil. So, if they're serious angels and they do a lot of investment, they know it's 1 out of 10 that they put money into. And think about it, it's 1 out of 10 for people that might be looking at a few hundred deals a year. And a venture fund, they're looking at 1,000 to 2,000 deals in a year, investing in 10, and only one's a hit. So it's 1 out of 1,000, 2,000. And sometimes that's not even the case. So yeah, they need to see a 10 to 20 times return. If not, then they might as well put their money in the stock market and buy DraftKings at a low price and hope it goes up significantly, right? So, or Caesars or anybody that you're looking at that's down, they look and say, my gosh, I'd rather buy this down already existing company with a good brand name than invest that money in yours. Marketing budget allocation on AI startups, since they are not putting much money as a platform business. Look, the more competitors you have in any particular space, whether it's AI or it doesn't matter what the business is, you've got to figure out how are you going to get your name known. And hence why you hire PR firms. My daughter runs a global communications company, mostly focused on the healthcare space. And she does almost exclusively venture-backed deals. And they really rely on her getting them good PR because they leverage the PR into more investment, into better brand awareness, all of those kinds of things. So I think marketing and PR are incredibly important, and that your budget should allocate that. But at the beginning, look, you're going to be contacting potential clients and getting beta testers and building up your brand before you spend any money on marketing. And if it's consumer driven, that you're trying to get consumers to go and use this, you're going to use TikTok. I know it sounds crazy, right? Because you think of these crazy videos, but I was just at a conference where Dave Riebman from Wharton and a bunch of other very brilliant people spoke, and they talked about the power of TikTok for almost every industry. And even for myself, doing the Angel Venture Fair, I've really got to get into TikTok and Reels and just say, here are 3 things, 5 things. If you've ever watched Reels, you see lots of business consultants, especially dating coaches, giving advice on there. So I think those things are powerful, and you have to factor that in. But there's a lot of stuff you can do on your own. And then as you grow more, then you'll have an agency that helps you. Similar to the question on contractors for an MVP, are strategic partnerships for critical systems like software viewed as high risk early on, or smart use of funds? I think a smart use of funds. Now, it all depends on who the strategic partner is that you're getting involved. But if you're a partner with Cisco, and if you are a partner with Cisco, one of the things they're going to ask is Cisco investing in this? And if not, why aren't they investing in it? So you have to be careful about the partners you bring in, and are they capable of investing in it, or are they willing to take half of their salary and stock in the company because they believe in it? So there's different ways, and different investors look at it differently. Some investors are glad for you just to spend the cash and not give up any stock. You might not want to give up any stock because you know the stock is going to be worth that much more. So, so if you can increase the capital by 10 times, where should be targeted for raising capital? I'm just saying to you that any investor like you are, when you walk into the 7-Eleven and you buy that lottery ticket, you're hoping it's a home run. It's the only reason they're mostly investing is because they're excited about the potential, and they're hoping that they have bragging rights at the country club that you made them a boatload of money. You just helped them buy that new Ferrari that they always wanted. They've taken this big trip, whatever that may be. That's why that's important. So that's never going to change. It's been that way for, hundreds and hundreds of years. When the King of Spain invested in Christopher Columbus, he wasn't saying, I just want 5 times rate of return. He wanted probably 100 times rate of return. That's why he put the money in. The people invested in the Panama Canal, they invested $5 billion in the canal back in the early part of the last century. It was the French investors, and they lost everything. But they were being told that they could get 10, 20, 30 times their money if this thing was successful. Are we going to take our last question or 2? Please.
We're going to take our
Okay.
last couple of questions. So if that was, we're going to respect the race time because we're a little bit over, but this has
Okay.
been fantastic. And as we said earlier, you all, this recording will be on the Amplify Louisville YouTube channel, so you can always reference back to it in the follow-up email that you will get. You'll also have all the contact information for Mark. Mark, you have been phenomenal per usual, always of ours. And to everyone on here, be sure to check out amplifylouisville.com to join our community, as well as keep track of all the other events that we have coming up like this. We have some awesome in-person things for July and August, as well as some virtual things. I'm going to try to get back on Mark's calendar so we can bring you all some more good stuff, because Mark is a wealth of knowledge. And thank you, Mark. Get you some rest. Everyone else, wherever you are, stay safe, be dry, and we will see you all next time. Thank you.
Thanks for having me. I hope everybody has a wonderful weekend.
Thank you, you too.
Take care.